You're listening to New Retirement Radio, brought to you by the team at Prout Financial Design.
Hello, I'm your host, Certified Financial Planner, Dennis Prout.
I'm Heidi Cartwright, Financial Advisor and RICP.
Advisors associated with Prout Financial Design may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of Integrated Partners, a registered investment advisor, or 2. Solely investment advisor representatives of Integrated Partners, a registered investment advisor and not affiliated with LPL Financial. Investment advice offered through Integrated Partners, a registered investment advisor. Integrated Partners and Prout Financial Design are separate entities from LPL Financial. Dennis Prout and Nathan Prout are solely investment advisor representatives of Integrated Partners and are not affiliated with LPL Financial. The opinions voiced in this show program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional before making a decision.
WTCM News Talk 580. Welcome aboard. It's New Retirement Radio with Prout Financial Design, starring Mr. Dennis Prout. Good morning, sir.
It is great to be here. Thank you, Ron. On January 15th, Thursday, 2026. For all you corporate dudes out there and ladies, you got to pay your estimates today, right? 115.
What do you have to do?
Thank you so much,
Tax
Dennis, for that
estimates.
reminder.
Oh, okay.
Yeah. That's
Estimates
what he's
for
referring.
25.
Is that a quarter?
Well, I'm switching the button off on that radio here this morning. Thank you so much, Dennis. Well, no, it's great to have you here with us. Thank you for listening. We have a lot to talk about. Your questions, always welcome. How would they do that, Ron?
They could pick up their handy little telephone, landline or cell, and call us or text us. You can't text us on the landline, but the number is the same, 231-947-0023, 947-0023.
And we welcome your questions. Just so good. So joining us this morning here, Heidi Cartwright, RICP and Executive Director. Good morning, Heidi.
Good morning, and good morning to everyone listening this morning, and it's my pleasure to be here.
Pleasure to have you. Nathan Prout, Managing Director and Master Elite Advisor with Mr. Ed Slott and Company. Good morning, sir.
Good morning. It's great to be here.
Is that
Check,
a new
check,
status
check.
there, Master Elite Advisor?
That's
I've
something
had
we've
that
had for
for
some
about a year
Okay.
now. You
All
need
right.
to be in the group for 2 years before you can get that status.
You have
Mostly,
to go
yeah.
to 6 classes and pass 6 tests
Yeah.
for that.
Yeah.
Those two. Yeah.
Mhm. And ongoing continuing ed, where they try to confuse you even though it's an open book test.
Yeah,
20 questions of
Continuing ed with Ed.
crazy stuff. And then over there, their Director of Marketing, Beth Shire. Good morning.
Good morning. It's great to be here, and I hope all of our listeners are staying cozy warm this morning. It's a cold one.
It is.
Put another log on that fire, baby. It was a brisk walk this morning. Oh.
Where did you walk?
Down near the bay. Yep.
Oh, that's
15 by 15, 15 miles an hour and 15 degrees, about.
you're a little
give or take.
exposed there.
Yeah, well, you better have layers on. That's all I can say.
Well, the bay was amazing yesterday. The waves. I couldn't believe the wind coming out of the north like that.
Really?
It was something to see.
I bet it was crashing against there, and some of the ice formations along the water, just stunning when that wind picks up. Oh man, talk about ice sculptures du jour, right?
Right.
Well, all right. So we got a lot to talk about this morning. If I can get the words around the, turning 59 and a half. 5 planning moves most pre-retirees overlook. Most overlook. First, as you approach retirement, certain ages come with their own planning rules, and 59 and a half is one of the most misunderstood. Most no. Okay, that's when I don't have to pay a penalty anymore to draw my money out, correct? Yeah, we get that pretty much. at age 59 and a half, it's the magic age, where most of us can draw money out of IRAs and, frankly, some other types of retirement plans with no 10% federal penalty. Many people see this age only as the point at the 10% penalty. However, it opens up also a valuable window, one that falls before Medicare begins at 65 and before RMDs, or required minimum distributions. Now, the RMD age has changed to either 73 or, if you were born after 1960, age 75, Heidi.
That is correct.
Isn't that amazing? Think of 59 and a half as not as a finish line, but as the moment your planning toolbox expands. Now, the only way that your toolbox will have expanded is if you'd actually saved. Now, we were talking about this beforehand, and it's a bit warm in here, so
Yeah, I just turned it
excuse me
down.
while I take off my coat.
We didn't know we
So
had heat until a
embarrassing.
couple of weeks ago. Now it's too hot. So
It's a bit
It really
warmish in
works.
there, you know. So, wow. You know, what are you going to do? The lights are so bright here, Ron.
Yes.
They just throw off so much light. Showing off all that white skin. Anyway, the 59 and a half is a key, but you have to have actually saved. Now, when Ed Slott was on last time, whenever that was, he mentioned the tax ramifications of having saved. And my thinking, as I thought about this last night, would be, well, he said it this way, and I thought it was a great way to say it. He said, the IRS is actually joint owners with you on your IRA account, leading some to perhaps believe that because they saved in that taxable account that they did something wrong. I wish I would have done that differently, perhaps, you're thinking. But I would say, here, perhaps not. Because you actually saved, you deducted it going in, because it was in an IRA or 401k or whatever, it came off of your taxable income, no matter what your income is. Number one. Number two, it grew tax deferred. Now, the problem with this is that Ed never came to one of my retirement planning classes. That's the real issue, where he could have seen this illustration. So, and the other part of it is that even if you were to save outside of the IRA, comparing it to the IRA or a 401k, because again, you deducted it, it grew tax deferred. Taking it out as a lump sum, the IRA balance, versus a non-qualified account, and paying all the tax on the IRA, going back again to that IRA, paying the full tax, the full ride, at that point, you'd still be ahead of saving it taxably, if you will.
Okay. So you're saying, so is it the same for IRA and 401k? If you say take $100 out of your paycheck every week and you
Sure.
put it into one of those accounts,
Yes.
you're not paying tax on that. So that's $5,000 a year or so that you're not paying tax on.
You know, sometimes these shows really should be in a podcast on a YouTube, because then we could show that graph to our audience, Beth.
I'll
See?
keep that in mind.
Well, the point too here, I think you're pointing out, Dennis, is the tax deferral status as well. Because not only do you not get taxed that year that you put the money in, but it's growing tax deferred, meaning you don't have to pay tax on an annual basis and reduce the amount, versus like an individual account where you would have to pay tax on an annual basis on any income or gains that you recognize.
The big picture is that you get to make these decisions because you saved. Now, is saving always fun? No. Are we always romanticized with it? Darling, you love me more, don't you, because I've got a 401k? Well, she might. I mean, you know, given how sexist I am. But given the reality of that, you know, most of the time we're not going to be applauded. Sorry, it's embarrassing, Heidi, I know.
I'm fine.
We're not going to be applauded with that. You know?
With saving.
With saving,
Yeah.
having saved. But the key is it makes you, Ed or me, any of us, have to make these other decisions where we say, well, do I want to give this to charity? oh my gosh, I can draw this as income. Whatever it may be for you, that can cause you to have to say, I have to think bigger. I have to think bigger, perhaps, than I've thought before. That's the fun stuff of this side.
I have a math question from the last hour. We had a guy in Sheboygan won $1 million. He's 65 years old.
$1 million.
$1 million.
Congratulations.
There you get the
Yeah,
special.
no kidding.
Yeah.
Good job, sir.
And he's going to retire and invest.
Okay.
And then somebody said, well, if you saved from early on, you would have $1 million. You wouldn't have to play the lottery. So my question was, I don't know if you can figure that out.
Yes.
We'll pick a 21. You want to say if you start at 21 years old,
Mm-hmm.
saving, how much would you have to save every week, month, year to have $1 million by the time you're 65? So 21 to 65. How many years?
$1 million is a future value, just so you know.
Okay.
And we've got, what'd you say, age 21?
21.
So we've got 44 years there,
Okay.
right, to get there. We'll take 44N. It's a number of years.
Okay.
All right. We'll just use yearly. We'll use a yearly amount.
Okay.
Now, what's the interest rate we want to assume there, Ron? What should we assume for an interest rate? See the variables that go into this.
Well,
6.
see, I
Pretty
know
conservative.
Dave Ramsey is usually assuming 12%,
12?
which is pretty aggressive.
It is.
So let's do somewhere between 8 and 10, maybe.
How about 8? Let's
8.
start more conservatively, because if you're saving that long and you're using mutual fund type accounts, generally, to cover ourselves, they hate it when we use interest rates, but generally,
Yes.
we could assume a conservative rate of 8%. The annual payment, $12,870 per year.
So if you saved about $1,000 a month from age 21 through 65, you'd have $1 million.
Yep.
But you wouldn't have really. Oh, that's with interest. That's with compounding.
Correct.
Right.
Now
And if
it's-
you do that into a Roth IRA or a Roth 401k because of that contribution size, all of that would be tax-free for you as well.
Yeah, that's even better.
Yeah.
Let's take a look at what that would mean on a monthly basis, and just looking at that. I'm not sure whether I didn't figure that out properly, because we're doing this on the fly.
Yeah, we can.
But the monthly sum is dramatically less, Ron. The monthly sum is dramatically less for 44 years, and that's what was making me suspicious. So $1 million future.
$1 million you want by
We've
when
got
you're
44
65.
years.
44
times
years.
12 is 528 months.
Ah,
Now, when we take that interest rate of 8% and divide it by 12, there's the interest rate. Jeepers, the details, Dennis. Yeah. $206 a month.
$206 a month.
Right. Yeah.
You save that
206.
for 44 years and you get $1 million.
Yeah. Yeah. Now, the negative to that, or the contra
And again,
argument, if
you
you
say
will,
generally, that's generally using your 8% interest.
that's
with that
8%, assuming that. Now, that's again, pretty conservative rate. Now, what's interesting about this is the contra argument, if you will, is, well, what about inflation? What's $1 million going to be worth in 44 years? Well, it's certainly going to be worth less. But if you started at 205, 206 a month, could you potentially increase that amount over time? And the answer is
Yes.
yes.
And you could increase it with the amount of inflation.
Yes,
that was
you could
in the
match the
previous
inflation rate, because generally your income's going to keep up with it. So
Or you could just keep your 401k contributions at a percentage of your pay, even if you don't want to think about it. If you say, hey, 5% no matter what I make, and they'll adjust those as you get raises, even if you only get raises for inflation.
Yes, indeed.
So it's having the lump sum, making these decisions, understanding that you've got options, understanding that these are great questions to talk with your financial advisor. I mean, these are the more advanced questions where you can say, what are the advanced things, if you will, that I can do with these retirement accounts that perhaps I hadn't thought of before? These are the high-end conversations you want to have with your financial advisor. Isn't that the most fun? Are we always going to sit at the practice table, if you will, and or the practice bench on the piano? If we're really good, at one point we're going to serve or going to be able to play Maybe in Carnegie Hall. Ooh. So if we're playing in Carnegie Hall, why wouldn't we want to have those high-end conversations? That's what I say. And why couldn't those be more valuable? Well, maybe I want to give a portion of this to charity. We've talked about that. What's the best money to give to charity? Almost in every case, hands down, is IRA money. Then it'll never be taxed in whichever way you decide to give it, whether through a beneficiary or a qualified charitable distribution. What about that appreciated stock you've got that you find irritating? I'm so irritated it made that much money. Not a conversation we often have. But given that you want to gift it to children and or then to charity as well, how would I possibly do that? What if I don't want to pay the tax and yet I don't want to write a check? That could be some of the best money to give. All of that appreciation goes tax-free to that other entity. You haven't paid any taxes on it. And if you're itemizing, you get to deduct it as an expense for the year against your own taxable income. You see, this can be fun. It really can be. Your planning toolbox expands. If you decide, number one, consider an in-service rollover. You can do an in-service rollover from your 401k to an IRA with most plans at age 59 and a half. Why would I want to do that? Potentially more investment choices. Well, my investment choices in my 401k are fantastic. Why would I want to do that? If they're fantastic, you may not. Okay? Perhaps better income planning. IRAs can make strategies like bond ladders and or income strategies that are easier for you to make withdrawals. Because Nathan said at our practice, what were you saying about taking withdrawals from 401ks? I thought that was interesting.
Yeah, I've run across a number of clients who are surprised by this when they go to set up systematic withdrawals from their 401ks, assuming they're retired at that point. Because, one, the choices of where the money comes from are very limited. Typically, when you do a withdrawal from a 401k, it comes a little bit from each fund that you have in there. And your tax withholding options are also, again, typically very limited. They will just withhold 20%, even if that's nowhere close to your effective tax rate, especially given how low tax rates are historically right now as well.
So they're locked into withholding 20%, and the amounts that they take out are dealt out pro rata amongst your various funds. And what if you don't want to liquidate XYZ fund because it's been such a great mutual fund? Sorry.
Or it's had a really volatile month and you have to sell more of it to hit that same monthly income amount. And that's where the sequence of returns risk can really hurt you as you go for those systematic withdrawals.
Right, that leads to the attrition of the whole portfolio. So.
And it comes back to the point, Vanguard did a study years ago, and they've continued to do this same study of a financial advisor. The difference that they make in portfolios tends to be for clients in their portfolios tends to be, it doesn't sound like a lot, but, and I've seen even greater numbers in this, but 2 to 3% or so. These minor changes and or things you can move toward your end or potential can make a difference to you financially over time. That can be significant. That's what a good financial advisor can do for you. What are the tax differentials? Where should I be drawing income? What's going to make the most sense given my various assets? You can help you look at the forest and not just the trees. Move number 2, enter the Roth conversion golden zone, which could mean future tax-free income, lower future required minimum distributions, and potentially Medicare and Social Security advantages, helping reduce Ms. Irma, income-related Medicare adjustments.
No one likes Irma.
No.
I feel bad for her.
Move number 4, start mapping out your Social Security strategy. This can help you do that. You cannot claim Social Security at 59 and a half, but this now is the right time to begin planning for it, because your income decisions today can affect how much your benefit is taxed. Tamale. Up to 85% of your benefits can be taxable, depending on your income. Taxable. Social Security benefits can be taxable. Having converted some of your funds to a Roth IRA can help avoid some of that tax, perhaps. Now, the last great piece of advice, move number 5, plan retirement in phases, not as one long block. Generally, phase 1, freedom years, age 59 and a half to 65. 2, stability years, perhaps, 65 to 75. Phase 3, legacy years, 75 plus. Spending often declines while healthcare needs can tend to grow. This may be the time to revisit estate planning and family involvement. How much do I want to tell the children? How much should they know? How can we do pre-planning with them? What and how do I want them to receive their assets? In what form and how would I like that to happen? What things do I really need to communicate to them? Even though, frankly, if I can say it, I'm uncomfortable with that. What if I'm going to treat one of them differently that might surprise them? Oh my gosh. That's why we need to have these estate planning conversations. You can make a measurable difference for them and for others who might follow along. So, turning 59 and a half creates an opportunity to step into a planning window, anticipate it, use it to your advantage. Small decisions made even at the ripe old age of 65 can make a huge difference.
And
for
Dennis, can I add a number 6?
You may, absolutely.
A number 6. I would add number 6. And what I would say is if you haven't had a financial plan done by the time you're 59 and a half, you should really think about getting one done. We bring in all these pieces that Dennis has just been discussing, and this is all a part of a financial plan. And it really gives you a little bit of clarity for those decision making in the next couple of years as you approach retirement. So I would add that.
You see this financial plan, you'll be a believer. It's amazing how much more information can be brought into one place to help you make much better decisions and to know, how are we doing? Can we do this? What, if any, adjustments do we need to make? I consider it. That's fun. That's really fun.
So you're going to talk in a while, Heidi, about what to ask a potential financial advisor?
That's actually Nathan. Heidi's
Oh,
going to
Nathan,
talk
okay.
about smart
I'm going to talk
planning.
about taxes because you know how everyone
Taxes.
loves
But I
talking
want to
about
ask,
taxes.
is 59 and a half, when you hit that age, if you don't have a financial advisor, is that like the time maybe you should say it's time to get on this?
A key time.
Yeah.
Any time is a good time, but use these ages again to your advantage to say, I guess I can make myself go visit these people. That's what I would say. If you've not had a visit with a good financial advisor, if you will, make yourself do it. It might surprise you. Okay.
So
At
that's
that age, though.
that's advice number 7. So now
There
we
you
got
go.
7, right?
But you can do like with one of your financial plans. You have that form you have people fill out. And after you sit with a client, they can walk out of your office feeling relief. Hey, we're on track for a good retirement. Or they can walk out and say, oh, well, guess we better
We got
start
some work
saving
to
a little
do.
more.
Yeah.
But they'll know where they are.
They know where they're at.
Yeah.
And how many of us like not knowing? I don't, So, yeah, it can really remove the mystery of this thing, whether it's passing it along more effectively and or making certain that you have enough. The wide spectrum or array of differences between those. Each area presents its own opportunities. I would just say, are you taking advantage of those? It's a great time.
All right,
take
one
a look.
comment.
You bet.
Two
You bet.
comments.
You bet.
Somebody wants to know where you get your 8% figure when you did the theoretical problem of how much do you have to save every month to get $1 million when you're 64 or 65? And you said we'll clock in a 8% interest rate.
Yeah.
That's
I'll just say we've shown clients a mutual fund that started in 1952, and it's not a growth fund. It's a growth in income mutual fund that's been around since 52. It's averaged over 11% per year. So 8% is not pie in the sky.
You're not going to get that at a bank.
You're not going to get that at a bank and a fixed account. We're talking 401ks where the assets are variable and can fluctuate up and down. That's the way you win over time. Okay? So 8% really relatively conservative. And we're trying, can we mute that? Thank you. Great.
Also, I think it's just somebody, 44 years, they say, of self-employment paying estimated taxes. Last time was January of 2024, so glad it's over.
Yes. Next, from Capital Group, Heidi, a SMART, or obviously smart approach to tax-efficient investing.
Yes, indeed. That's what we're going to be talking about. So what exactly is tax efficient? Tax efficient is paying the least amount of taxes required by law in any given situation. So that is what we're talking about today. And a lot of times we use these little acronyms. I know in our coaching, that our business coaching, they use these all the time. And so they're using that acronym of SMART. And so the first letter S is for stay. Stay focused on an objective. Don't let taxes be the tail that wags the dog. If minimizing taxes becomes the sole focus, the asset allocation could quickly become misaligned to clients' objectives and risk tolerance. So what they're saying is that tax efficiency should be considered in the context of your particular financial goals, not just pursued for its own sake. If you are overly focused on reducing tax liabilities, that you can risk losing your direction or maybe missing out on some of the goals that you want to achieve. So don't let the goal of being tax efficient take over all of your decision making, but be measured.
That's where great counsel comes in. Someone that's willing to say to you, okay, I get your focus on tax saving. That is important. But don't let that tail wag the other dog in terms of where your returns can come from, and also taking appropriate risk given your own financial situation. How do you continue to perhaps pay some tax as time goes on so that you don't have a giant liability sitting out there, either for yourself or for your spouse or children as well?
Yes, indeed. So let's move on to the letter M. The letter M is for maximize. Maximize your after-tax returns. So it says, while no one enjoys paying taxes, well, at least I don't know anybody. I don't know if you guys do. But I don't know anybody who enjoys paying taxes. Owing capital gains tax can be a good problem to have because it indicates that your strategy of investing for growth is actually working. You're actually making money on your investments, which is probably the goal that you have in mind. Efficient investing is about maximizing after-tax returns consistent with your objective and not just simply lowering tax in the near term. You want to look at the whole picture like we were saying. And so let's move on to the letter A. The letter A is standing for asset and vehicle allocation and location, which sounds a little confusing. But what they're talking about, what asset is in which account? Different types of accounts, different types of your accounts are either taxable or tax advantaged. And so they should hold different types of asset classes, asset types, different securities because of the different tax structure that each account may have. So we're talking about retirement accounts, which are called qualified accounts. That would be Roth or Simple or SEP or any kind of IRA, 401k type of accounts. Or there's non-qualified accounts out there, and those are the accounts that is really, I just tell people this is regular money. This is money that you've saved. It could be in a trust account, an individual account, or a joint account. So different assets do better in different types of account on a tax basis. Tax-efficient assets generally should be held in taxable account, while tax-inefficient assets should be generally held in tax-advantaged accounts.
So inefficient investments might be those investments that throw off fully taxable income, like CDs. Now, while you're getting, let's say, 4.5% on your CD, that is, if it's held outside of a retirement account, is fully taxable. What does that mean? Whatever your bracket is, you got to subtract, let's just say, 20% off of that. 20% off the 4% means you're getting subtracted by almost 1%, 0.8% to be sure. It's just, what's the net, okay?
Right, and I actually discussed some of this in a class that I ran last year, and I talked about the difference between mutual funds and ETFs, or exchange-traded funds. And one unique thing about exchange-traded funds is that they entail greater tax deferral because they tend to generate fewer capital gains. Because the way the product is structured, it doesn't recognize capital gains the same way that a mutual fund recognizes capital gains and passes it on to their holders or their shareholders. So looking at what you have in which account, you may want to change up your asset strategy or your allocation for those different taxable accounts. So then we move on to the letter R, and R is for rebalance. So what is rebalancing? Rebalancing is systematically selling investments that have grown beyond their target weight and buying those that have underperformed. So what you can envision here is like a pie chart. And when you have an allocation, maybe you have 10% in a growth fund and 10% in an income fund. So you have that pie chart. And what they're saying is that if you just leave it alone and you don't reallocate that it can start to skew. Like maybe you have a really good year in the growth fund and you get a lot of reinvestment in that fund. And now maybe instead of 10%, you have 20% of your account is in the growth fund. Well, that's a lot different if you are concerned about the risk in that account. So rebalancing will bring it back to that original plan.
Now, why do we... Check. Yeah. Now, I was thinking as Heidi was talking about this, why do we talk so much about this? Why is it important to you? For most of us, it's because of the responsibility shift that we've got. Now, we may have all of our money invested in real estate and or other assets. At some point, what if some of that becomes liquid? And how do we invest that? How do we make it grow as responsibly as we can? How do we begin to make those better decisions and focus on how to do this? What are the measurable things you can do differently? There's a great book called Atomic Habits. And he says this, and for those of you that have seen this book, it's about making micro changes to these things. That's where it really winds up making a difference over time. It's tremendous what it can do for you.
It is. And when we're talking specifically about rebalancing, if we look at the whole portfolio and you feel like it's a little out of whack, where you should go first to rebalance is looking at those qualified accounts, those retirement accounts, because those are tax deferred accounts in most cases, and so it will not impact your tax in that given year in rebalancing versus a non-qualified account where there could be some tax ramifications for rebalancing. So all of these complicated pieces of the puzzle need to come together when you're thinking about changing allocation and rebalancing.
Sometimes it's just a fresh set of eyes taking a look at your financial situation and saying, here's how you might do this differently, and here's how it can make a difference for you. Could this make sense? There it is.
Yeah. And I think Nathan asked a really good question earlier when we were talking about this before the show. Do you remember, Nathan, what you said? You asked, how often do we rebalance?
Yeah, I think that was actually Beth that asked that question.
Maybe it was Beth. I'm sorry, Beth. I was thinking, maybe Nathan answered it.
Yeah, and this can be, it's different for every person. Don't you love that answer, right? But whether you have a specific range of, hey, I invested in this one sector or this one piece of my portfolio, and I only want it to be 10%, let's say, of my total portfolio. Well, it just had a great year, and all of a sudden now it's like 16% of my portfolio. It's like, all right, let's look at that extra 6%, if this is right for you, and reallocate that to different parts in your portfolio so you don't get too focused on one sector or something like that.
Yep.
That's a good example. That could potentially be the case. And or then you can make that decision, well, I want to leave that at 16 in some cases.
You absolutely
I'm
can.
okay with that
Right.
risk. I understand the extra risk, but I'm also looking for the potential that might afford me as too.
Right. Yeah. Especially, it's, and so many things come into that decision. It's like, well, if I hold it for another 2 months, then it goes from a short-term gain to a long-term gain. It's like, okay, let's keep holding it. But
There you go.
Yeah.
You don't want to do it too often
Exactly.
because
Yeah.
that sort of
Yeah. Part of
Puts you
the
off
reason that we produce these statements that we do in-house through our providers is so that you can see these allocations. When we sit down with you as a client, and for those of you who do this, we go through, okay, how's our allocation? Where are things at? How do we make adjustments? How do we intelligently take a look at this and see where the opportunities are? Okay, you're missing a sector here, and or we ought to increase this particular portion. Yes.
exactly.
And also, Dennis, when you were speaking about when you were going through your article and the 59 and a half and the opportunities and the decisions that present themselves at that age, but also to remember that it's important to set the stage so you are able to make those and really seek guidance and talk to a financial advisor before you even enter that time where those decisions have to be made.
That's right. It's like having a good accountant, frankly, because you've established a relationship with someone that you can feel as comfortable as you can, relatively comfortable with sitting down with someone and reviewing this. How can I do better? Isn't that what all of us want to know? It seems rather obvious.
If someone's not using a financial advisor,
Yeah.
I know one of the questions you might ask is the risk level. Don't you ask people if they want to be conservative, or I don't know what your levels are. But if they're not using a financial advisor, they're not really approaching their retirement from that angle, are they?
Well, they may not. And it takes me back to years ago. A gentleman came in and we reviewed his portfolio, and I congratulated him. I said, oh, my gosh, you're rocking and rolling with this. But he was extremely thoughtful. I spent a fair amount of time at it. Not everybody wants to do that. Everyone's different. So we may say simply, honestly, you're doing a great job. Here are 2 or 3 things you could do. Or it may be, here's how we can help. Then let you make that decision. So, of course, as we've said, everyone's different. Beth, stats, what do we got?
Yeah, I want to start out with our very own stat from our podcast producer. He contacted me and let me know that last year he edited over 2,500 minutes of new retirement radio.
And he's still got his sanity. I mean, that's
right.
Cool. Yeah.
And those, all those podcasts are available on our YouTube channel. You can look those up. It's absolutely fantastic, and it's a pleasure to be able to provide that to our listeners. And it's just a joy.
What's the name of the YouTube channel?
Prout Financial Design.
Oh.
Just
Sorta
under Prout
tricky.
Financial.
Yeah.
Okay.
Yeah.
It's not New Retirement Radio or whatever?
No, we
Catchy.
have them, on our
It's
Prout
under
Financial
Prout.
Design. And we also have our full video available on there as well.
Okay, so
Is there-
proutfinancialdesign.com.
Yes.
Is there a link to that on your homepage?
There is,
Yeah,
yes.
okay.
Yep, just on the YouTube link down below. And
But you can go to proutfinancialdesign.com and link to it?
yes.
Yes.
Yep.
Thanks,
Yep,
Ron.
absolutely. And then from Fidelity, U.S. stocks have started this year on a strong note, with the S&P 500 index hitting an all-time high, while technology stocks ruled 25. Healthcare and material stocks have been some of the biggest contributors this year so far, perhaps an early sign that the rally may be broadening.
All right.
Right? Diversity.
Cool.
And then the S&P 500 closed 25 with a 16.39% gain, which is the third straight year of double-digit gains. The NASDAQ Composite also averaged just over 20%, while the Dow saw a 12.97% increase.
Which many of the advisors are looking over their shoulder, if you will, for a correction. Most likely, we're due for some sort of correction here in the price action, given how vociferous it's been. How's that?
How was, offhand, approximately 2022, you've said before, wasn't one of the great recent years. There was a downturn.
That was
Do you know how those
painful.
major indexes did on the year? For
Everything lost. Bonds
everything
and
was down.
stocks that year. First time in 45 years that it happened.
Jeez.
Yep.
That was a
Was not a fun time.
But
But what's interesting is, of course, since then, it's done very well. Now, what's interesting, too, is the average bull market, I think it's about 6 years. So we may have some room to run here. We'll see. The fuel, the soil, if you will, for continued increases in the markets is there. Of course, there could always be untoward things that occur as a part of it. Now, I love what Warren Buffett says about that. Usually, you can discount the worst-case scenarios, and things don't turn out nearly so badly as what might have been anticipated. I love that kind of advice.
I was just looking at the low point on the S&P 500 here. It looks like it's doubled. It was like 35.83 at its close back on, what was that, October of 2022? And it's almost twice that now.
Yeah, almost $7,000. Isn't that interesting, Ron? Now, investing over time, being patient with those rates of return, that's where you become amazingly served well over time, as long as you can handle some risk even in your portfolio. It's incredible what can happen given that patience, diversification, and if it matches your own risk tolerance as much as possible, okay? Among other things.
Thanks again to Prout Financial Design, Dennis Prout, Heidi Cartwright, Nathan Prout, Beth Shire.